last part that I get to talk to you about, we're not going to talk about the politics. We're not going to talk about current markets, really. We're not going to talk about anything going on today. We're going to talk about how Sixth Meridian spends time thinking about making forecasts and how we think about making long-term forecasts on your behalf and looking at what we think the financial markets are going to do. And so this is something that we internally focus on, and we are going to go through how we think about decision-making and making forecasts. So Mark Twain, I think, has a quote for about every situation. In fact, John had one, he didn't realize it, in his speech when he said, the future doesn't repeat, but it might rhyme. That's a Mark Twain quote. But this one I think is great as we think about decision-making, and it really goes to our certainty about different situations, and the challenge being that oftentimes what gets us in trouble is what we actually think we're at the most certain about. Today we're going to talk about two elements that go together. Both of them come from a book. The first one is a book called Thinking Fast and Slow from Dan Kahneman. It's about a 500-page book, and I can summarize it for you in 2 headlines. There are 2 ways that we think. We have a system 1 and a system 2. System 1 is very quick decision-making, and system 2 is much more deliberate and well thought out. And then the second one is a book called the Fox, or the Hedgehog and the Fox, and the title of that book comes from a saying that's about 2,000 years old from a Greek philosopher. And it says, "A fox knows many things, but a hedgehog knows one big thing." What that means is a hedgehog are people who have a deep knowledge, high competence in one particular area. That's a definition of a hedgehog. And a fox knows a variety of different things, but doesn't have that deep level of knowledge. And I'm going to come back to both of these, decision 1 thinking, or system 1 and system 2, and then also foxes and hedgehogs and how that relates to as you think about making forecasts and think about the future. Okay, this first question, we're going to ease into this. So this is one that I think is going to be not that difficult for everybody. 2 + 2 equals, everybody got it? The answer is 4. This is system 1 thinking. Nobody had to think about that. 2 + 2 is 4. You see your spouse, you recognize their face immediately. You're driving home, you know immediately how to get there. This is just stuff that we know, but you don't have to think about. So you immediately respond. That's how hedgehogs, who know a lot about a certain topic, immediately react when information is presented to them. So I'm going to show you a little quick video for a hedgehog responding to a question.
Okay, Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. This is really, look, if there's one takeaway other than a plus 400 somewhere, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly. Don't be silly.
Okay, just so you get a sense of what's causing the agony by this point, I know you've been talking about it. It's financials led by Bear Stearns after what essentially is a bailout from the Fed. Bear Stearns shares are down 90% this morning, and it's not just Bear. Pretty much every single bank is plunging in early trade this morning.
If you've been to these before, this is the second time I've brought Jim Cramer up. I like to use him as an example, and not because Jim is smart. Jim goes on TV every single day and makes predictions, and some of those are going to be wrong. But he is the definition of a system 1 thinker, a hedgehog. He immediately translates everything into I'm bullish, we buy it, we sell it. There's not a lot of nuance in terms of how he looks at the world. And that's how hedgehogs view things. They have a tremendous amount of overconfidence. If they're a portfolio manager, a lot of overtrading. They will have concentrated portfolios. And these are all 3 things. If you're sitting down with a Sixth Meridian advisor, they might say 3 things we want you to avoid would be these things. But here's the other thing. If you get invited on TV, that's how you have to be. That's the only way people who are on TV, who get interviewed, get asked back. Because nobody wants to have an interview with somebody on TV, interview somebody like me, and they say, well, what do you think about the economy for the rest of this year? You say, well, there's a lot of variables. It could go this way. It could go that way. Nobody wants to see that. I would say, it's going up. There's no doubt. That's what people want to see. So get your phones ready. We're going to poll number 2. This one is a little, so we eased in the first one. This one's a little bit more difficult, okay? So here we go. A bat and a ball together cost $1.10. The bat costs $1 more than the ball. How much does the ball cost? Okay, so the correct answer is 5 cents. The one that comes to your mind in System 1 thinking is 10 cents, right? But the reason it's 5 cents is the ball costs 5, the bat costs $1 more, so that's $1.05. You add those together, you're at $1.10. Everybody in this room can do that problem, but it isn't immediately the answer that comes to mind, right? So when you get asked that question, immediately the answer seems like it should be 10 cents. So now we're going to talk about, or I'm going to show you a video clip from an example of this is a Goldman Sachs CEO a number of years ago on Charlie Rose. And the question that he gets asked, the audio is a little bit unclear, but the question that he gets asked is by Charlie Rose, how far into the future can you see?
Well, I'm in the risk management business, so I don't take it for granted that I can see behind. I don't think I could see 4 inches into the future. Yeah. I'd say that most of my...
but your firm has a reputation of being pretty good at understanding the future and being able to make some analysis as to about what risk to take.
Well, I'll confess to you that what I think we aspire to is less foresee the future and more be a great contingency planner. And sometimes you contingency plan really well and you can respond very fast to what's happening because you thought through all the possibilities. You can get off the mark so quickly it looks like you false started. It looks like you anticipated the start when all you've really done was listen so closely and knew what you were going to do that you got off the mark quickly. I think it's hard enough to predict the present. Yeah. You know, think about it, perspective. It's very hard to step out of your context and see what is happening. I have views about the future, but I'll tell you, we're not in the business. You wouldn't be a very good risk manager if you let what you think was going to happen have too great an influence on what you planned for and protected against. What we really do is we really contingency plan.
Pretty different perspective, right, when you think about those two outlooks. And for us, I think that it's a little bit dated, that clip, in terms of when it came out. But I talk about this, think about this, share it with my team, how relevant that is to what we do. That we aren't here to predict the future. We're really here to react as quickly as we can to new information because the future is inherently unpredictable, obviously, right? We know that, and I'm going to come into that here in just a second. So Fox and System 2 thinking, very deliberate, very calibrated, high bar to make changes. It's going to be very diversified. We saw JP Morgan showed you that diversified portfolio. It never is at the top, never at the bottom. And so that's what we want to do when we are thinking about making our forecasts on your behalf, on all of our behalves, in terms of thinking about what's likely to happen. So obviously it feels like the System 2 thinkers, Foxes, are going to be better at making forecasts. So let's look at some of the historical research or the data on the ability to make forecasts. This is a study that was done about 10 years ago, and it tracked 68 experts. And when I say experts, these are very well-documented people. They're in the press, they're well-regarded, they're highly educated, and they made close to 7,000 forecasts over this period of time. And over this period of time, don't focus too much on the actual numbers of this graph, just focus on the shape of this graph, because the shape is what matters. This tracks their accuracy in making forecasts. But what's interesting is this graph almost exactly mirrors a graph if we as a group were to flip a coin 1,000 times. And if we flipped a coin 1,000 times, there would be a run where we got 7 heads in a row. That doesn't mean we're good at flipping heads, right? We would have a run where it was head, tails, and then a long run of tails. But over time, it would all end up, after those 1,000 flips, to be 500 heads and 500 tails. And that's what this study showed, is that all these brilliant gurus and all of their forecasts, it was basically the same as a coin flip, which makes sense. I just said, the future is hard to predict. It's inherently unknowable. What would be easier is if we did know the future. For any of you who are familiar with movies, this is from Back to the Future 2, and in that movie, Biff gets a copy of the Sports Almanac delivered to him as a teenager, and he knows the future, and he's able to win all the horse races, all the baseball games. And by knowing the future, he was able to make a fortune. And so as investors, oftentimes we think, if I could just predict the future, if I could just get some insight into what's going to happen, then I would be able to be like Biff and get rich. Well, we are going to go through that as a group. This is a book written by a guy named Nassim Taleb. He wrote The Black Swan. Some of you have read it, and he's very provocative. And he had a quote, and he said, if you gave the average investor the next day's headline 24 hours in advance, he would be broke in less than a year. Not he would be rich, not that he'd be flat, but he would actually be broke. So if you knew the future, could you make any money with it? Would it be possible to transact on that? So we're going to do a little experiment as a group, and we're going to see how we do given that we have the future. So get your phones ready. So you now are just like Biff. We're giving you the future. It's February 23rd. On February 23rd, Russia invaded Ukraine in 2022. So on February 22nd, you get advanced notice of the next day's headline, Russia invades Ukraine. So the question to you is, what happens to the price of oil? So the price of oil on this date is $92.35. You have tomorrow's headline. Do you buy oil because you think the price will go up? Do you sell oil because you think it's going to go down? Russia is one of the largest producers in the world. They are going to be sanctioned. You know this information. So put in your vote and tell us what you think. Are you buying oil or are you selling oil with the advanced knowledge of what's going to happen? So I'm going to give you some insight into everybody in here. You all would have bought oil. Despite what you put on there, you all would have bought it because that's how we would have reacted. We would have assumed that given that information, the price of oil would go higher. So here's what on February 25th actually happened. This is the headline from the New York Times, and the price of oil is on the right-hand side of your screen, and the price of oil basically did nothing. It didn't go up much. It actually went down slightly, which is very counterintuitive to what you would have expected given this geopolitical event. So sometimes, even knowing the future, if we know that snippet, that little bit of information, it might not be that helpful because sometimes if it's in the news, it's already reflected in the price of the financial market. It's already reflected in the price of oil or whatnot. So now I'm going to talk to you a little bit about things that you read or you consume or hear on TV. This is a headline from Business Week in 1979. In 1979, we were coming out of the 1970s. The equity markets had a very difficult decade. And Business Week put out this headline questioning, does it make sense to invest in equities anymore? I think the actual headline is the death of equities. And so when this headline came out, it's heavily cited when you are reading financial history. This is heavily cited as being the absolute moment when you should have bought stocks, because when it got on that headline, that's when you should have bought stocks. And for the first year, it was a little bit small to see, but what happened is in that first year, you should have bought stocks. They went up by 25% post this headline. But then as you go forward for the next 2 years, stocks came back down. And so after 3 years, actually, this headline was correct. And so one of the issues we have with forecasts is what's your measurement period? How do you decide if you're right or you're wrong? Do you measure it over a week, a year, 3 years? And then as you go forward for the rest of this decade, stocks just took off. So the headline, while it was right or it was wrong, then right, then really wrong over the long haul, there are other examples of magazine headlines. This one is from The Economist, the end of the oil age, and what this really was, the end of the bear market in oil stocks, because of the moment that this headline was published, oil and gas stocks tripled over the next 3 years. So when you're looking at information, when we listen to people making forecasts, you have to decide, is the forecast they're making new, relevant insight, or is it something that's already in the news? Okay, get your phones ready. So now we're going to think about our next forecast is going to be on a longer time horizon. So the last one I gave you was a very short time horizon. This is a longer time horizon. You're given $100,000 on December 31st, 2014, and you have to invest in one of two countries, and you have to hold it for 10 years. Country one, the GDP growth rate for that country will be 5.8% per year, and for country two, the GDP growth rate will be 2.1%. So now choose, you go with country one or country two. I think logically it makes sense that the country that has a 5.8% growth rate in GDP over time will deliver a better economic outcome. I mean, just the compounding over 10 years of 5.8 versus 2.1 is dramatic. I don't have the number off the top of my head, but it's very significant. So very logical and very incorrect. So this is what actually happened. Country one was China and country two was the United States. So China's growth rate was significantly higher than the United States over that period of time. And over this 10-year period, the returns in the United States were triple what the returns were in China. But what's interesting is that when you go up until 2020, it was a tie. And at that moment, 2020, if you remember, is COVID. And what happened is the two countries, in terms of how they dealt with COVID, was dramatically different. And so you saw a big divergence between the returns. And then the second big event was the release of ChatGPT in the United States, which drove a huge return to technology stocks in the United States. The point being that even if you have the data, and sometimes that is not that hard to forecast, long-term returns or long-term economic growth because of demographics and other factors is not that hard to produce. We could get pretty close if we went through the top 15 countries in the world and forecasted their next decade growth rate. We could get reasonably close. But that doesn't necessarily have anything to do with what the return would be for those stock markets, because what the current PE ratio is, how those countries treat shareholders, how shareholder friendly are they, all of those come into play. So that leads us to, okay, what's the point of forecasting? Andrew, you've gone through all these polls, they've been kind of clever or not, up to you. But what's the point? Does it work? Does it add any value? And this is the final book we're going to talk about, called Super Forecasting. And in this book, he tracked the forecast from 1984 to 2004, so 20 years of experts across both financial predictions, geopolitical predictions, just a whole litany of different things. And the conclusion was exactly the same. Individual forecasts made by these highly educated, successful people were about 50-50. It was basically like a coin flip. But he then said, but I think that there's something more to this. So he started a new project, and it was called the Good Judgment Project. He recruited several thousand people across the country to participate, and they were given all these different issues to make forecasts on. Geopolitics, financial, a variety of different issues. And when he did that, after the first year, he found that there was a small cohort that actually was pretty good at making forecasts. And they all were, based on their psychological profiles, they were all foxes. It wasn't the person who's the worst at forecasting geopolitical issues in China is the guy with the PhD in Chinese history. They're the worst. The best were people who had this broad base of knowledge, the foxes. So what they did is they put those people on teams and had them then start forecasting together. The results got even better. And then the third thing they did is they started doing some training with them to teach them about doing probabilistic thinking, and they got additionally better. And so this is relevant for 6 Meridian, and on your behalf, for you, because then we incorporated this thinking about how do we broaden our sources of inputs, our sources of insight, so that we can be better at making forecasts about what we think financial markets are going to deliver going forward. The final point on issues that you need to be aware of as it relates to making forecasts are the biases that exist in all of us when we're asked to make a prediction about the future. This is a poll that was asking voters what their forward expectation was for inflation over the next year. And what you see is, coincident with the election of Donald Trump, a dramatic shift in what Republicans and Democrats thought inflation was going to be going forward, neither of which really makes sense. Democrats said that they thought inflation was going to go from 1.5% up to about 4%, and Republicans said they thought it was going to go from about 3.5% to 0%. And those were driven not because of this new analytical framework that people had, but instead by the beliefs and biases that they exist. So that's just a point that we make as we bring to every forecast that we're making. What are the biases that we need to be aware of? Here's the final poll that we're going to do before we get to our conclusion. So if you get your phones ready. And this one is related to interest rates. I'm going to lay out the framework for the situation. You have a mortgage that you need to refinance. It is July of 23, and the Fed funds rate at that time is 5.5%. You read an article, Reuters has said 90% of economists say the Fed is going to cut interest rates by 50 basis points before year end. So do you refinance your mortgage now when the Fed funds rate is 5.5, or do you wait to the end of the year after the Fed has already cut? So we're going to put that question up, and now we're going to get everybody's perspectives. Do you wait, or do you refinance now? You would wait. The Fed is going to cut rates, which mortgages are market-based interest rates, and you would want to wait to cut. Again, you're very logical and very incorrect. What's interesting, though, is that the Fed didn't cut by 50 basis points from July to December. The Fed actually cut by 100 basis points. So they cut by double what they had said they were going to cut, and the 10-year interest rate went up by 25 basis points. I can't tell you right now why the logic of that, why that happened, but it reinforces that so oftentimes when I talk to clients, they say, well, what do you think is going to happen here? And what I should say is, you don't want to know what I think because it's going to be wrong. And I couldn't make any money if I could forecast it, because all of this demonstrates that even if I could tell you what was going to happen, I couldn't then translate that into, well, what are the financial markets going to do? How will the markets react to that? So that's the challenge that we face. So bringing this to a conclusion, we're going to talk about what does this mean for 6 Meridian and how we're making forecasts on your behalf. Before I get to financial forecasts, though, I want to talk about the forecasts that every one of us deal with every day. You wake up immediately, before you check the news, before you check your email, you check the weather. And you want to know, what's today going to be? And everybody thinks that the weather forecasts are not particularly reliable. And that's not true. You're wrong. Weather forecasts on a 1, 2, and 3 day basis are highly accurate. If they say it's a 60% chance of rain, I know every one of you thinks it never rains, but it actually rains 60% of the time when they say it's a 60% chance. But as you go out multiple days for weather forecasts, the predictability becomes less and less and less. And by the time you get to 14 days, so if you're looking out for 2 weeks, what you think the forecast is going to be, even if you're looking out to next weekend for Memorial Day weekend, it's highly inaccurate. And what they actually do is they go back over the last 10 years on that same day, what's been the average temperature, the average wind speed, and they just tell you that's what it's going to be. And only until you get to about 3 days out, maybe 5 days, can you rely on anything from the weather forecast. What does this have to do with financial markets? It's exactly opposite. So financial markets on a short-term basis are impossible to predict. What's going to happen today, tomorrow, next week, over any short period of time, financial markets are impossible to forecast. But on a long-term basis, financial forecasts actually become much easier. And we have a lot of data that we've looked at in terms of forecasting long-term returns for the bond market, for the stock market, and we have over 70% predictability in terms of what those returns are going to look like. And so when we put together our long-term forecasts, we tie in a lot of experts, a lot of people's inputs to help us put together what we think the long-term forecast is going to be. When you go home tonight and you're talking to your kids or you're talking to your wife or your spouse, and they say, well, what did you learn today? The one thing you can go back, all of the stuff today is that a collection of foxes that are together is called a skulk. So you can take that and you'll have something at dinner tonight to tell your family, I learned something. A skulk is a group of foxes. And so that's what we try to do, is we try to find a collection of foxes. We get them all together, and they help us then put together these long-term forecast for what financial markets are going to do. And what you'll see is, you can't see it because the print's pretty small, but the variety of opinions across different asset classes can be pretty wide in terms of what they think the return is going to be for the bond market, for the stock market, for emerging markets. And so we take that, we compile it, Jason, myself, and others on the team, and we put that all together, and then we start making our own adjustments based on what we're seeing. And that's what we use when we put together the forecasts that you see in your financial plans. And so they aren't random numbers that we pull out of the air. We don't just say, well, whatever it's been in the past is going to be what we think it's going to be in the future. We think it's pretty well thought out, a pretty well anchored assumption about what type of returns over the next 7 to 10 years you can expect from the different parts of the portfolio that we manage on your behalf. And so the thing I'd want you to take away from today is, one, be very questioning when you hear forecasts, even though this morning we had a lot of them, but you should be very suspect when you listen to or you think about forecasts being made, because it's very difficult to get the future right. And then think about when we're making our presentations and we're talking to you about what the returns that we think we can deliver in our financial models, those we think are very well thought out. And I'm going to have the last word for Yogi Berra, because I think it's perfect as you think about the forecasts that are being made. It's really difficult to do. So thank you all for coming. I think Margaret's going to do some closing remarks for us. We appreciate all of you, and I hope you have a good rest of your day.